Good afternoon, everyone. Welcome to our webinar. This is Chad Webb. I'm the managing partner at ADDICUS. I appreciate everyone taking the time to join us today. This is going to be a very good session. It's very real time, and I think it'll be very helpful to everyone that's here to join us today. I want to be brief in the introductions and go ahead and jump straight to the business. Many of you know us at ADDICUS as you are either our clients or people that we do a significant amount of business with. For those of you that don't know us, ADDICUS is a full service firm for high wealth individuals and small businesses. We focus on many things, but as it relates to today, one of our specialties and really our sweet spot is focusing on tax efficiency and capital planning and also balance sheet optimization. We have a very good regulatory practice where we are able to identify things that are going on in the regulatory space and understand how those regulations may impact our clients, which is what put us here today. With that being said, I'd like to go ahead and introduce our panelists that are going to be joining us today. I've got, as you can see on your, still on the slide, the previous slide, but people that will be joining us today are Brandon Dixon. Brandon is our general counsel at ADDICUS and a tax lawyer, LLM, and serves as a primary point of contact for all of our tax matters. Jay Pope is also a CPA and a senior advisor with ADDICUS. Jonah Gruda, I'll get into his introduction more in a minute, but joins us from Mazars, USA. Lee Seegers and Steve Dwyer are with Dwyer, Cambridge, Suffren, and they are real estate attorneys that are also working with us on many of these projects. Today, we're going to be talking about some things that are very, very relevant based on some things that have happened due to the CARES Act as a result of COVID-19, as well as some recent legislation that's either come out or that's being contemplated. So it's going to be very applicable for those of you that are real estate professionals, people who own commercial real estate properties, those of you who are with businesses or C Corps that have any previous losses, and even those who are not currently real estate professionals could probably benefit from some of the requirements here. So some of the things that we'll get into today, as you can see on the slide, are cost segregation and some qualified improvement property matters. But number 8 here on time-sensitive considerations is very important because, as we'll talk about today, there have been things that have come out since we've organized this webinar to today that we will update you real time, and so I'm not going to spoil where we are there. But I do want to take a little time to introduce our special guests because one of the things that we do at ADDICUS is we feel like we bring the best people really in the country and the world to the table to serve our clients and prospects. So I mentioned how we handle things in the regulatory space and emerging matters that come from the regulatory landscape to make sure that we're taking care of our clients. We also do that by working with people who are with bigger firms and across really the globe to make sure that we're bringing the right folks to the table. One of those people that we work with a lot is Jonah Gruda. Jonah is with Mazars, USA. He is a tax partner there and obviously a CPA. Mazars is a very big firm in this space, and Jonah represents some ultra high net worth clients and works with ADDICUS in a number of different capacities, whether it's strategic planning for our clients or their clients, but he's a very good partner to ADDICUS. Additionally, with us today, we have Lee Seegers and Steve Dwyer. I mentioned them from the outset. They are real estate attorneys and represent folks really across the spectrum in the real estate industry. They have been working with us a lot, especially as it relates to these matters, because the tax legislation, as we're going to talk about, and another reason why we have the CPAs and tax attorneys on the phone today, or so I don't know if I'm having some difficulty here or not. I'm getting some different screens, but in addition to having Jonah and the CPAs and tax attorneys here, we also have Lee Seegers and Steve Dwyer and they're here to address some of the real estate matters. So with that, I'll go ahead and kick it off. And I apologize for my technical difficulty if there was any. I'm not getting any feedback. And I'll kick it over to Jamie Pope. Jamie?
Well, thank you very much, Chad. And thank you for everybody being on the call today. And this is really probably one of the most exciting times and also one of the most troubling times in America. And people today want answers. They want solutions. And we're bringing you some great solutions and answers today because these are significant opportunities for you to receive actual cash refunds from your taxes, a source of capital without having to liquidate assets or take on additional wealth. But what's the most important thing I'd like to stress to everyone is this is a very time-sensitive matter. And Brandon and others will talk about that as we move along. One of the things that I think everybody needs to understand right off the bat is this, is that there are many people in America taking advantage of what we are discussing today. As a matter of fact, this morning's Wall Street Journal identified Marathon Oil is anticipating over $100 million of tax refunds, and these same strategies we're going to talk about today. Chipotle, over $15 million. So these are ideas some of the largest companies in America are taking advantage of that we can bring directly to people on this call today, and you too can take advantage of those calls. We're going to talk about briefly how you actually harvest these savings. The number one thing to remember is this: you probably already have on your balance sheet the items needed, but we have to go in and identify those items. We have to many times go in, and one of the things that I do is we provide specialized engineers reports for you to be able to take advantage of some of these through either a cost segregation or accelerated depreciation study, also applying bonus depreciation, and also something known as qualified tenant improvements that we can talk more about later. But the important thing to know is this, is that there are answers. We can get those answers for you. Some of these require studies, they require review, and they require guidance from the right people. And that's one of the main things we want to help everybody with today, is provide you with that correct guidance and start a conversation. And Chad, I will go ahead and pass it back through.
Yeah, thank you, Jamie. And with that being said, one thing that I neglected to talk about on the beginning is that I really want this to be interactive. This is, again, real time. Of course, we've got a canned presentation, but we also want to make sure that we take time for Q&A and address some of the more real-time legislative matters as we can go through the slides today. Jonah, will you go ahead and kind of kick this part off and talk about how you believe this will be valuable to the audience?
Sure, thanks, Chad, and certainly thanks for the rest of the panelists. Hopefully everyone signed up today because you believe the CARES Act affects you or a client. Certainly there are no cookie cutter answers if we should be taking advantage of any of these provisions. And understanding that there may be a lot of unintended consequences excuse me, of acting haphazardly, we're going to attempt to identify very specific situations that can add value to you. So just because you have a loss that might be eligible for carryback, it doesn't always mean that you should. Most of the measures from the CARES Act include a 5-year loss carryback, which is certainly the bulk of what we're going to talk about today, made some technical corrections, and certainly adjusted some other provisions. These measures are designed to give businesses and individuals greater ability and flexibility to use those losses and other deductions to offset their income now and for income in the past, providing them with liquidity now and certainly a reduced cost of capital as they grapple with the economic effects of the pandemic. Now, these measures generally are welcome to expand the options available to taxpayers to access this internal funding. The interplay of these provisions with the older Tax Cuts and Jobs Act really requires careful evaluation of their potential benefit and consequences. So for those that are unaware of the technical nuances or who may be aware of the broad benefits, this presentation is really for you. And those that have really good professional advice and have been keyed into these things for a while, maybe this is just going to be some information that's going to really reaffirm what you already know. So I think we could kind of really get right into the heart of the presentation here. We can move on to the next slide. I must say, everyone's given me the least amount of time to talk about the most important piece of this. So I'm going to try to touch upon a lot of these things, but hopefully thanks. So I think it's going to be prudent to really start with a very, very brief history of what the earlier net operating loss provisions were, along with some of the recently enacted business losses that now significantly impact the availability and calculations of those losses.
Hey, Jonah, this is Drew. Can you do me a favor? Just really quickly, high level, explain what creates an NOL. We kind of skipped past that.
Yeah, I'm actually going to really excess for any trades or businesses, and let's take our real estate executives, business expenses in excess of business income at a very, very simplistic level.
Yeah, and Jonah, this is Chad, and I think one thing too to make sure everyone understands is why we're here today is what can you do if you have an NOL? What does this mean at very high level? What's the opportunity and value proposition before we get into the detail?
Sure. So the CARES Act is suspending some of the prior provisions that limited carryback. The Tax Cuts and Jobs Act did away with the carryback and enacted an indefinite carry forward. What the CARES Act did is suspended those rules. It also eliminated the ability to limit your business losses to $500,000 for taxpayers. Basically what that means in a nutshell is if you have a loss in 18, 19, or 20, we could carry that back to years where last year you weren't able to do that. And certain limitations on those losses are alleviated, thereby freeing up that liquidity that was tied up in those years.
Perfect.
Got it. Thank you. So, yep.
So the point that's important to make is prior to the rules from last year, taxpayers could only carry back those losses 2 years and carry forward 20 years. Those losses in those years could offset 100% of income in those years, 90% if the taxpayer was an AMT. The Tax Cuts and Jobs Act came around a little bit later and said you're not allowed to carry back those losses anymore, and the carry forward period is indefinite, as I mentioned, but only allowable to 80% of your taxable income in a year that you had those deductions. So we have great value to real estate professionals that were limited in 18 and 19. Those losses that we could now take are retroactive to 18, 19, 20. So the CARES Act loosens those restrictions in a number of beneficial ways. First, the losses arising in a tax year in 18, 19, 20 can be carried back 5 years, so as far as 2013. It's important to note the corporate tax rate was 35% then, and the individual tax rate was 39.6% in earlier years. The CARES Act also temporarily removes the taxable income limitation, allowing the NOL to fully offset corporate level and individual income in 18, 19, and 20. So as a result of the additional excess business loss a taxpayer could have in 18, 19, and 20 that would otherwise be capped, those could then also be carried back 5 years as well to 2018 and pre-2018 year losses. This is huge because that will free up some cash, understanding though it may not be as immediate as folks would think, because for losses that are generated in 19, we need to file a tax return, which now they're doing, extensions are due in July, the returns are due in July as well. And then 2020 returns are not complete as well. So those losses may not be able to get actualized until 2020. I should mention that REITs are not allowed a carryback for REIT in any year to any preceding taxable year if that NOL arises in a non-REIT year. It may not be carried back to a preceding taxable year that is a REIT year. So again, a lot of nuance here. The calculus is not so easy. We need to understand the interplay of what other provisions might be impacted in those earlier years as well. So if you had, foreign tax credits or other credits that were a function of taxable income, you need to make sure you're not losing that benefit by now bringing back those losses. Additionally, keep in mind that in earlier years, you had an AMT tax that was affected by a portion of your NOL. So you might be recovering more losses, but you may then have to adjust your alternative minimum tax, which may or may not result in a significant reduction of that NOL.
Got it.
So, Jonah,
Drew, Jonah, this is Chad. I'd like, sorry about that. I'd like to ask Drew. Drew, will you put that in perspective in terms of what this means, you know, at a very high level, right?
Yeah.
In terms of,
I think it's easy for us to get into the deep weeds on this, but I want to kind of keep bringing this back to a very lay perspective that's easy to understand. And there's certainly no offense to you, Jonah. We've got to get technical, but I want to kind of keep bringing it back up to 30,000 feet. And what we're basically saying, what Jonah, I think, to boil it down to a very simplistic point of view with caveats that more detailed analysis is needed, is basically this. If you already have a loss in either 2018, 2019, or 2020, you now can effectively turn that loss into cash, very much needed cash during this time. And if you don't have a loss, or even if you do, there is a possibility of being able to make that loss much larger, thus turning it into that much more cash now. So it's effectively creating, this is a terrible term, but I'm going to use it anyway, somewhat of a free loan by using depreciation and other things to generate losses and turn those losses into tax refunds.
That's right. And what we'll get to later on in a few slides is in 2018 and 2019, some of the provisions that were just recently changed allow us to now create losses where they may not have been able to be created because some of the glitches we've had in the drafting of some of the provisions. So you're right, to oversimplify it, if we have some trap losses or created losses, this act allows us to free them up and put some money in our pockets, provided some of the rules are in line with some of the facts.
Yeah, and there's obviously a lot of detailed analysis needs to be done to weigh and measure against AMT and other interactions of the tax code and those types of things. But for especially real estate developers, we've got a couple of family offices that we interact with that are heavy in the hotel business. This is not a great time to be a hotel owner by any stretch of the imagination. You know, some of the analysis will be, hey, you know, what are my options to generate liquidity to stay in business? And when it comes down to that, you may have to give and take a little bit and say, you know what, this isn't the most tax efficient thing long term, but it's what I need to do right now. But I know what you were trying to say, Jonah, which is we need to be very thoughtful and consider all the ramifications rather than just running off and doing this. But I did want people to get the high level headline, which is this is about converting losses that either exist today or could exist into cash.
Exactly. You're right. We need to really take a holistic approach to how this is. And I should mention, for clients that had restructuring or acquisition transactions in prior years that closed, whether they were acquirer or acquiree, it might be a great opportunity to look to who's entitled to those refunds as well. So that is something else that you should discuss with us or your other advisors to make sure that any of those trap losses from transactions that had already occurred might be able to get recouped as well.
okay.
Well, thanks, Jonah, and Drew for the summary of what the benefit is. We're going to turn now to the real question in my mind: who can benefit? And we touched on this just a few minutes ago. Jonah did in his discussion, but first off, it's taxpayers who have non-passive NOLs in 2018 through 20. So this can be for any reason, but if you have a NOL that existed in 18 through 20, those years, under prior law, as Jonah noted, that would have to be carried forward. So on your prior year's return, it was reflected as carry forward. Now we have the opportunity to go back and carry that back to potentially 2013 for 2018 loss, and then 2014 for a 2019 loss, and so on. And that can generate a benefit, which we'll see here in a second on the next slide, if you paid tax in those prior years to which you carry the loss. The second group, if you did not have an existing NOL, the second group is possibly real estate professionals. Now, real estate professionals are it's a subset of taxpayers who, in general, taxpayers are often limited with real estate activities by the passive activity loss rules. And these rules limit your ability to use losses generated from real estate activities, and particularly rental real estate activities, against active income. Qualified real estate professionals, these are individuals who are active in real estate trades or business, and generally spend more than 750 hours engaged in real estate trades or business each year. And because of that, their losses can be used to offset other active income. And so if you are a real estate professional, this is important to you. And how does this affect you? Well, as Jonah alluded to, there were some glitches in the TCJA, which was enacted in 2017. One of the intended provisions was to allow for bonus depreciation and 15-year depreciation for qualified improvement property. These are tenant improvements, and think of that. So restaurants, shopping centers, those improvements were intended to be allowed for, the professionals were allowed were intended to be allowed to deduct that bonus depreciation attributable to those improvements, but then also deduct the remainder over a 15-year period. The problem is the statute did not exactly follow congressional intent. And because of that, those improvements were left to be deducted over a 39-year period attributable to the property, the real property. Congress went back in the CARES Act and fixed what we call the real estate glitch or the retail glitch. And they redefined qualified improvement property to be depreciable over 15 years and to qualify for bonus depreciation.
So, Brandon,
so if you're a real estate professional,
Brandon, this is Drew. So, notice we again want to kind of keep this. I know we have to get a certain amount of technical. I want to keep bringing it back high level. So, if I'm a supermarket, let's just say, and I lease a store, but I'm responsible as the tenant for doing leasehold improvements to the store, rebuilding, certain walls, plumbing, HVAC, that kind of stuff. Those are what we're talking about, right? And that property previously would have been 39-year property, not eligible for more accelerated write-off. Is that accurate?
That's exactly it. Yes. And so now that property is is eligible for bonus depreciation. And so because of that, you can, if you had that property, then you could go back and you could potentially have an NOL arising from the accelerated depreciation and bonus depreciation. And we'll take a look at an example of that here in a minute. The other categories are C corporations. If you have a C corporation, it's really important to take a look at whether you can benefit from this for several reasons. Number one, if that C corp was involved in an acquisition where they acquired a company through a tax-free reorganization, for example, where that had a NOL, ordinarily they would be limited from utilizing that acquired NOL on their own return. However, the CARES Act relaxed those limitations, and so it really just made that acquisition more valuable because now the acquiring corporation can utilize that NOL to go back, get a refund, and obtain cash. So basically utilizing their predecessor's NOL. Owner-occupied real estate is another important area, and we'll look at that.
Brandon, before we move into the owner-occupied commercial real estate, I want to make a couple other notes about the C corporation. You know, one, obviously, a lot of times C corporations do have large amounts of assets, manufacturers, things like that. But the other thing to point out is that let's just assume you have a loss in 2018 of $1 million. That loss has an actual value on a federal tax basis because of the C Corp tax rate of 21%, $210,000. The value of that loss by carrying it back carries it back into years when that tax rate was much higher, 35 and even 40%, based on a tiered rate schedule. So that the actual cash value of that same $1 million could be as much as double carrying it back as opposed to carrying it forward, not to mention the time value of money.
That's a really good point. And we actually have a slide that will illustrate that particular scenario coming up. With owner-occupied real estate, just real quickly with this, you have an opportunity with that sort of real estate. You can use the grouping rules under the passive activity loss rules to make that income active. So if you have owner-occupied real estate, you might want to consider utilizing the grouping rules in order to take advantage of these provisions and generate a loss that you can carry back. If you're not a real estate,
if you're not a real estate professional, but you are a physician, for example, that owns their own real estate, leases it to their business, this could apply to that physician, correct?
Exactly. That's exactly who these rules apply to. So they can make that election. It would generate potentially a NOL, and then they can carry that back. Especially, think about it. If you built a building and finished it out, then there is that potential there. Even if you're not a real estate professional, even if you were not a real estate professional in 2018, for instance, if you're a real estate professional today, then you can potentially generate a loss, go back. If you have an active loss now, let's say that, let's use the example of if you were an active real estate professional in 2018, but you were not in 2013, then you could still carry back that loss that's generated in 2018 and actually generate a refund from deductions that were locked up in 2013. So that's a really important opportunity, especially if you became a real estate professional in that 5-year period. Let's move on to the example.
That'd be much more likely for that to happen in 2020. Now that you have foresight of being able to plan, you could become a real estate professional this year, generate a big loss on your real estate, and carry it back to years where you were not a real estate professional, correct?
Correct. That's possible, yes. And that's where really the planning in this is involved in managing those activities. I think a lot of the discussion so far, we talked a little bit theoretically. Let's actually put some numbers to this and see how it would work out. Here we have an example with a real estate professional, and in the top portion of this, where you'll see in 2018, for instance, they have $2 million loss and $300,000 of carry forward loss. The top portion there, where it says current scenario, that reflects the rules that were applicable prior to the CARES Act, basically. And as you can see, that loss that's generated is carried forward and is utilized on a limited basis through 2020. Now, this also reflects not only the fact that, two things. Number one, because of the TCJA, you could not carry it back. Number two, the losses are limited by the 80% excess business loss limitation that Jonah alluded to. And if you take that scenario and then you look at the revised scenario, what we see is that we're able to, in the revised scenario, we've taken an additional loss, that $4 million. What could it be attributable to? Possibly doing a cost segregation study, identifying QIP, taking that bonus depreciation. But which we'll talk about here in a minute,
So Brandon,
you have a $4 million loss now.
Brandon, just to point this out, we're under 2018 in the second scenario down there. That $4 million blue number, that is new depreciation taken from either cost segregation or from qualified improvement property where we bonus depreciated it. But you can do this
Correct.
even retroactively back into 2018 if the tax year is still open from an audit perspective, and in fact, all 2018 returns will still be open and eligible to be amended.
Correct. So we could go back now and we could identify additional opportunities, additional deductions that were either not taken or that are allowed now because of the CARES Act, and generate a loss. And what we see is because of the carryback provisions, we can take that $6 million loss that was generated in 2018, carry that back to 2013, and where we previously paid $525,000 in tax, we can take that now as a refund. As you'll see, though, we still have some carryover left because of that. We have $4,500,000 carryover, and when you carry that loss back, it then carries forward through the period sequentially, and any loss, any income that you have in those periods, it will absorb that loss, so that when you get to the end.
So effectively, Brandon, we're taking the $6 million from 2018 loss, the $2 million of original loss, plus the $4 million of new loss. We're carrying it back to 2013. We're getting a refund in 2013. Then we still have a bunch left over, $4.5 million. We didn't pay any tax in 14, so no refund there. So now we got $4.95 million carrying forward into 2015. Big refund there. Same into 2016. Big refund there. Then we didn't have any tax in 2017 or 18. We pay a little bit of tax in 2019 and 2020, but that's future. We don't even owe our 2019 tax until July.
Exactly.
And 2020 won't be owed till sometime later this year or what have you. So when you really look at that,
exactly,
what's happened is we've generated $1.5 million of cash out of just being smart in terms of how we restructured our depreciation.
Yeah, and the important point of this is, number one, you're putting cash into your pocket today. So we have a mechanism here where we can go back and we can get that cash today. Yes, you may be paying, you're going to be paying tax in future years, but a dollar today is worth more than a dollar tomorrow. So time value of money, and then just having that cash in your pocket.
Particularly in this environment, we've done a bunch of webinars about this, talking about cash is king. The forward-looking view of the current pandemic is completely uncertain, and nobody knows how long it will last and what the full impact will be. So getting some cash in your pocket now, I think it's more important than it's ever been. It's not just about return, it's about survival.
Right.
That's right.
Drew,
now, I want to make one last note. Okay, Chad, sorry about that.
Yeah, this is Chad. I want to ask both of you, and I'm going to direct it to Drew first, and not to get ahead of some of our Q&A, but as it relates to the slide, let's assume that I'm somebody who has commercial properties and residential real estate rental properties, and maybe some vacation rental properties, and maybe I don't have any NOLs right now, right? That I'm carrying forward, and I assume this can still benefit me. I'm not really understanding how. Can I basically use what you're talking about in revised depreciation method rules from the CARES Act and go back to my previous years to generate NOLs by the revised depreciation method rules and generate a refund? And if so, what's the limit there? Are you basically saying if I paid taxes in previous years and I don't have an NOL, but I own properties like that, I can use the revised methodology and go back to generate an NOL, which I could still get a refund for? And what's the limit? Is that what you're saying?
Yeah, so I would tell you it depends answer. So the answer is, if you are a real estate professional, So there's an issue of, yes, can we do everything you just said? Yes, we can. We can go into all of those properties, do some analysis, do some cost segregation on those properties. There may be certain qualified improvement property that we can write off. We can do all of that. The second part of that question is, can I take all these losses as a taxpayer? Do I qualify? Well, it depends on whether you can meet the qualification or if you maybe already do as being a real estate professional. If you own that many rent and commercial and residential rent properties, through grouping of your activity, it's quite likely you could become and or maybe already are a real estate professional. We would want to plan through strategically, how do we do that? Do we go back and try and take that position in a previous year? It would probably make more sense to do it in 2020, but that's going to delay the timing of getting all that money back. But yes, we can do everything that we just said. Chad, I do want to be mindful
Right, so-
we're probably a little over on this subject.
All right, go ahead.
And I just want to lay one foundation for a future slide that's going to be very critical. Notice the effect of the loss carry forward here in the carry back. You have a carry back to 2013. The statute requires you to carry it back before you carry it forward, unless you elect out of the carry back. So just keep that in mind and notice the effect on this slide. And we're going to come back to that point here in a minute. I want to go down to the slide 10 and just real quickly show this is the effect, if you're a C Corp, the benefit to a C Corp of the NOL carryback. And really the large benefit here is due to the fact that prior to the TCJA, from 2013 to 2017, the tax rate was 35%, whereas after the TCJA, the tax rate has now dropped to 21%. And so what you're able to do is use today's dollars against a higher tax rate and basically generate the refund. So it's more valuable to you by doing that. And this example follows the prior one, but that's the point of this one, is just to show how the difference in tax rate can affect the carryback and the value that it has to C Corps.
All right, thanks, Brandon.
I think we're going to move on now and talk about cost segregation a little bit more in depth.
Great. I guess I could speak briefly on this. I know it's been mentioned. I know we like to simplify things. So right off the bat, cost segregation is a very commonly used strategic tax planning tool that allows companies and individuals who've constructed, purchased, expanded, or remodeled any kind of real estate to increase the cash flow by accelerating depreciation deductions and deferring federal and state taxes. Now, how does it work? When you buy a piece of property, you're not buying the property structure, but you're also buying all the interior and exterior components. Think of it as an amalgamation of all the different type of interconnected systems. Generally, and if I'm speaking out of turn, please chime in, sometimes 20, 30, 40% of those categories, depending on where and what, would fall into categories that could be written off much quicker than a 39-year business building structure. So a cost segregation study dissects the construction costs or purchase price of the property and puts it into a 5, 7, or 15-year category, which is eligible for bonus depreciation. Some of these studies get so detailed, they'll look at the type of nails used or screws used in certain systems and reclassify it. So the study helps to separate all of the different structural components, the roof, the window, HVAC units, so you could properly classify to get accelerated depreciation, or you could target a loss deduction when they're replaced. This also applies to leased property and tenant leasehold improvements as well. How'd I do with that one?
Great. Jamie, you did a great job. Jamie, can you step in just real quick and kind of talk a little bit about, like, this is a study I know that you did, and just talk about generally how that works.
Sure. So cost segregation, one of the best parts of investing in real estate is that you get to write the cost of your investment off over time. That's the good news. The bad news, it can take up to 40 years to claim all those deductions. Why? Because it's through a mechanism known as depreciation. Depreciation means my building wears out a little bit each year. So you can take one of two methods. You can take the straight line method, or the accountants. This is what a CPA can generally do for you. They take whatever you paid, divide it by 40, that's your write-off each year. Or they, many times, because they hire some of the folks I work with do this, bring in an engineer study. And if you do that, and as Jonas said, we literally can look at every nail in the building. And the IRS says if you do that, some of the items in the building won't last 40 years. They're either 5 years, 7 years, or 15 years, what they call a useful life. So we separate all the components, and some of them you can write off in 5 years, some of them in 7, some 15, the rest stay at the 39. The example you're seeing on your slide today, this is a retail center in Doral, Florida, did this study on, and you can see it says it has class life. So some of the items could be moved to a 5-year. Think of carpets, you know, they wear out in that time frame. About 25%, 15-year, that would be some of your specialty lighting plus the landscaping and site grading and other parts of your building, about another 12% of that. So in this example, 36% of the cost of a building, instead of you having to take over 40 years, you now can take, if it's a new purchase, right away. Or one of the best parts of doing one of these studies, you can do it at any time you own the building. These particular folks had owned this building for about 6 years. So if you've not done a study and used accelerated depreciation, you can do a study at any time, and any of that accelerated depreciation you hadn't written off in a hurry in the past, you can take and do what's called a look back study on that and take all those in the year that you do the study. That's why on the previous slide, as Brandon was speaking, that's where that big loss came from. They had all this property they had not accelerated. They could accelerate. They did. They put it on the tax return. This particular building, we found it was a $2.7 million building. The total write-offs on it claimed to just a tad over $1 million, and their 40% combined federal and state tax bracket. They're anticipating a tax refund of $402 because we took that $1 million they hadn't taken before, added it to their tax return in a particular year, and the strategies we've been talking about today allows them to go back and receive refunds. Very important to know. We can do that this year. Most years you cannot carry them back that far. So it's very important that we take a look and do these.
Thanks, Jamie. All right.
So a lot of what we've been talking about from the beginning was how we generate NOLs, how we use NOLs, how we use excess business losses, cost segregation studies. A lot of that is only possible now because of this technical correction that's been colloquially known as the retail glitch, which affects restaurants, retail shops, hotels, and any other businesses that made, interior improvements to non-residential real property. The way the drafters of the Tax Cuts and Jobs Act drafted the depreciation changes, they intended there to be a category of qualified improvement property. They drafted it so quickly, they got halfway there, but the code section never really existed. So they intended to allow these write-offs for costs associated with their QIP. Instead, the final text mistakenly failed to classify such property, as we mentioned before, having a 15-year recovery period, causing businesses to depreciate their improvement costs over 39 years. 39-year property is not eligible for bonus depreciation. It's 20-year or less. This is why cost seg studies are really important, and actually going back to 2018 and looking at the balance sheet and the fixed asset schedule. So this CARES Act includes a technical correction that clarifies that qualified improvement property is classified as 15-year property, or 20 years using an alternate system and eligible for 100% bonus. The correction takes place as if it were originally enacted in the Tax Cuts and Jobs Act last year. So as a result, subject to certain limitations and requirements, businesses can immediately amend their 2018 return, 2019 returns if they're completed, to claim that one-time qualified improvement deduction that were disallowed for those years. What does that do? Well, assuming you qualify, assuming all other things being equal, this QIP, this retail glitch, allows clients to go back to 18 and claim either refunds via amended returns or change in accounting methods. So yet another tool in our arsenal to generate cash that's been kind of trapped inside of a company.
And Joan, I want to just quickly hit this, and we're going to talk about this more in a couple of slides, but not only can you do that, you should do that, right? I mean, that is the accounting method. That it's 15
Yeah, I
years.
want to jump in and say you're required to do that.
Correct.
And it's
failure to do
Yeah.
so is an impermissible accounting method. So we'll talk about that more here in a minute, but just want to make that point.
That's right. That's right. So we could certainly move on to the next slide if we want to move forward. So again, where are the benefits? These two slides really sum up everything that we've been talking about thus far. We look at our fixed asset schedule. We do that cost segregation study. We're going to break out assets that are on there at 27.5 years or 39 years, and then we're going to break it out. We're going to identify our 5, 7, 15-year property. And then after the reclassification is done, we're going to have this huge depreciation deduction that was trapped. It's going to create a net operating loss, or it's going to create an excess business loss. Both those provisions have been changed in the CARES Act to be much more taxpayer friendly, that I can now go back to 2013 for 2018 returns. We have until June to do that. Same thing with our accelerated depreciation, is we're going to take larger current year depreciation expenses that are going to create these losses that we are going to recoup cash in our pockets by then going back and amending some returns. So really important here. I think this slide really sums up in a way what's the end result of looking at our NOL provisions, looking at the ability to do cost aggregations, looking at the retail glitch, looking at the suspension of the excess business loss provisions. All that results in generating reduced income that could be used in earlier years, or if we want to, use it to bring forward to years where we know we're going to have large transactions that future value is going to be much more beneficial to preserve for them.
Right now, we're going to turn to on the next slide. We talked about what the benefit is, who can get it. We understand that now. Question that we're going to address in this slide is how do you get it? And we if you take away anything today, I think that this is one of the most important slides that we have, and one of the most important things we're going to talk about. So first off, if you have the loss and you have an NOL, you've identified it, you want to carry it back, how do you monetize that? There are really two ways. The first way is to file an amended return. And so for an individual, that would be a 1040X, for instance, or for a corporation, that would be an 1120X. That method is possible. It's one way of doing it. The other way is to file what's called a tentative refund request. And what the tentative refund claim does, it's a quick refund claim. It's a statutorily authorized mechanism that allows you to generate a refund where the refund is really just attributable to a carryback of an NOL, and there's no change in any items on the return for a prior period. The benefit of doing that is that statutorily, IRS is required to issue that refund if they will review it, determine if there are any computational errors, and if there are not, then they're required to issue that refund within 90 days. And so you get a relatively quick turnaround in IRS terms. The time periods, though, for filing that tentative carryback adjustment request, because of the CARES Act, absent any provisions, they would have already closed. Typically, you have 1 year from the date of the original return in order to request a tentative carryback adjustment. In this case, if nothing had been done, then that would have been problematic for taxable year 2018, for instance, where the return was already filed and you're past that 1 year date. Unfortunately, the statute, the CARES Act, was enacted pretty quickly. It did not address the issue, and but IRS has stepped in and used the regulatory authority to issue a revenue procedure that will allow taxpayers to carry back or file a tentative refund request for an additional 6 months after the statutory deadline. And so you have an opportunity still to get that quick refund if you have an NOL and you're just seeking to carry it back. You're not seeking to do bonus depreciation or a cost seg study. Now, if you have those opportunities, if you have QIP, or if you want to do a cost seg study, then you're going to have to file an amended return, a full-blown amended return. In that case, you're going to have 3 years from the date the return is filed, or was filed, in order to file that amended return. So you have some time there, but it is a bit more cumbersome procedure. You may say, that's great. Okay, well, what if I do nothing? What if I just don't have any of these? What if I want to carry my loss forward? I mentioned a few slides ago that the statute that authorizes NOLs, it actually requires you to carry the NOL back if carryback is available. So you have to carry it back for 5 years unless you elect to forego the carryback and carry it forward. Typically, that election has to be made at the time the return is filed. But because of these provisions are essentially retroactive, Congress has allowed you to amend those elections. So you can elect to carry a loss forward, and for some people that may make sense, although typically not.
So, Brian, I want to stop right here. This is probably, of all the things we talked about, it's probably one of the most important points of the entire webinar, okay? And that is, I think some people are probably scratching their heads and say, well, I don't know, maybe this applies to me, maybe I should do this, maybe I shouldn't, what have you. But I think this is the point we are trying to make here in this particular point, in point 3 on slide 14, is that the carryback, because of the way that the law is written, is not necessarily optional. It says you will carry it back. So if you don't carry it back and you wait till after June 30th to address it and you don't do any other amended returns, what happens? And by the way, I just want to point out that this is a position based on, stringing different laws together. And so it's kind of like the payroll protection loans. There's a lot of unanswered questions, but I think this theory makes a ton of sense.
Yeah, and there is actual doing some research on this today. There are actual cases where this happened, but what happens is you could lose that benefit of the carryback. You could be mandated to not only carry back that loss, and for which you get no benefit because you filed no refund claim, and then because you had that carryback, you're not going to get the benefit going forward. So you could actually wait.
I want to put that in real terms.
Brandon, you could potentially lose all of it.
Yeah, that's what we're saying.
Yeah.
So let's work through a scenario here real quick. Let's say, go back to my supermarket example. I've got a supermarket, has a ton of qualified improvement property. And in 2018, they retroactively fixed this retail glitch. All right. So I was required to adjust my depreciation schedule in 2018. Right. So I take $5 million of assets that was 39-year life. I convert it to 15-year life. Also, bonus depreciation is automatic. I have to elect out if I don't want to bonus depreciate. So effectively, those
Correct.
assets just became bonus depreciated back on my 2018 return if I do nothing. And if I fail to carry the NOL back or elect out of carrying it back, instead carrying it forward, that could mean that $5 million of depreciation could just evaporate, because by the time they discover it, I would have no ability to go back and reclaim the refund.
That's exactly right. And
So
so
the point we're making here is, this is not something that you just should decide, well, I might do it, I might not do it. You should do something. You should either decide I want to carry it back, or I don't want to carry it back and I want to carry it forward, or I want to elect out of bonus depreciation. But this is not one of the situations where doing nothing is a good answer.
yes.
Drew, so let me
And
ask you
because
about
the
that.
statute, because the statute
Hold on,
mandates this.
Yeah, let me ask you about that, Drew, before you get off that point. So let's say I'm somebody on the call who's not a CPA, right? And go back to your supermarket owner or whatever, and get in somebody who owns real estate. How do you guys determine when to make that decision, or how do you know if you go back to try to generate the refund, or what do you do to make sure that you don't lose it going forward? And how fast do you have to do it?
Well, you see right here that you've got until June. So if you want to just claim the NO, if you have an NOL and you want to go back and just get a refund, you don't want to do anything fancy or different, June 30th is your date.
Right.
If you don't want to go back and get that refund, or again, if you have qualified improvement property, you should look into this. This is not something and you need to do it by June 30th. You need to get into the numbers and the analysis and look at your tax returns, your detailed depreciation schedule, talk about it with your CPA. Call us if we can help you. We'd be happy to do that. But you need to look at this, and you don't need to wait 3, 4, 5 weeks, because you're going to be out of time.
Yeah,
So
and,
this
if you
slide
get,
needs to be
and especially if you
bright red
have
lights.
qualified improvement property, that again, you're mandated to take that 15-year depreciation. IRS has already commented that using 39-year depreciation would constitute an impermissible accounting method. So go back and at least make the decision whether you're going to affirmatively elect out or do a change in accounting method, which IRS has added this to their list of permissible or automatic changes in accounting method that will be allowed. It just has to be done. It has to be addressed, as Drew said.
So real quick, just to wrap this up, there are some remedies if you screw this up, but what our concern always is the longer you get away from the screw up, and especially when you don't realize that you have screwed up, the chances of going back and fixing it are slim to none. So I think this is something you want to really perk up and pay attention to. Dig your tax returns out, talk to your tax advisors, call us, but this is not something you should sit on your hands and say, well, I might do that. I think you ought to look at it really hard.
Yeah, I think,
Yep.
and
Okay.
just more to the point, you need to do some analysis in this anyway. So sit down and you really have to do the analysis, and you might as well go through and make those elections, make that affirmative decision as to what's going to happen.
Right. And so that's great counsel, but I want to remember that not everybody is a CPA who can run the analysis. So talk to me as a real estate investor and, somebody who can go to my CPA or you guys. What do I need to do? Put it in real terms for me. Drew, you want to handle that?
Yeah, I mean, I think what we commonly ask for is, our standard ask looking at this particular subject to get, and I'm basing this on a real estate professional or somebody like that who owns lots of different commercial and investment property. We ask for a copy of their last, back to 2013 1040. Want the full 1040, any K1s received, anything like that. So 2013, 14, 15, 16, 17, 18, and 19 if filed. Would love to have a projection of 2020 income, and would love to understand what properties you own and get the tax returns for those and the detailed depreciation schedules. If we get those things, it's a pretty darn good start to get a high level understanding of what's out there. We can come back and give you an analysis, say, look, conceptually, this is within 20% degree of certainty. This is what's out here. If you'd like us to go forward, we can dig into it further, and we can strategically figure out where would be the sweet spot, in terms of bonus depreciation, electing out on certain classes of assets. This is not uncomplicated. This is very strategic, and it's like pushing on a marshmallow. When you push it on one side, the other side pops out. So there's very much interplay with the different tax rules, and you want to take that into consideration. And that's working with the set of professionals, including your existing CPA, et cetera, is what we do.
Yeah, and,
Right.
and
Okay.
to your point, Chad, unfortunately, this is a complicated analysis. I mean, there are so many factors. You have multiple years involved, and to really understand the effects and how this is going to play out, you really got to sit down and look at it holistically. So you need that assistance of a good CPA. You need somebody who can run those numbers and can really analyze, the effects not only on your taxes but just cash flow in general.
Sure. Well, look, thank you for that. And, we ought to keep this slide up here flashing in bright red and yellow lights. But I do want to make time for Q&A. And I think that's one of the reasons why most people joined. We did get some questions in advance. So I'd like to do that. And I'll go ahead and address some of the questions that I did receive in advance. And then I'll kick it to Cammie for any questions that we might have received for the chat during the session, or if anybody wants to submit something and ask something, you can get that to Cammie now. The first question is, my company owns and leases both residential and commercial real estate properties in New Orleans. All but one of my tenants has requested some of the rent abatement or concession due to COVID-19. I have great tenants and want to keep them. How can this help me? Cash flow is grinding to a halt. With that, I think this is a good time to kick it to our strategic partner, Steve Dwyer. And Steve, if you would first introduce yourself and give a quick introduction, and then address that if you don't mind. It's already put you on the spot.
That's all right. I'm gonna pass it off to Lee in a minute. But I'm Steve Dwyer. I'm the managing partner of Dwyer Cambry and Sufferin. We are a full service commercial real estate firm in New Orleans. Of course, we do things across state lines all over. But I'd like Lee Seegers, who works with us, to take that question.
All right, thanks, Steve. Yeah, this is Lee Seegers. I believe the question was related to someone who owned and leased both commercial and residential real estate. If you go back and look at slide 12, I believe we went over the definition of qualified improvement property, which applies to non-residential interior improvements. So don't necessarily always equate commercial with non-residential, as non-residential is defined under the tax code. But so to answer your question, this is going to be related to your commercial tenants. So at that stage, well, the first question is always, do I have qualified improvement property? Assuming you do, let's go on to the second one. Did I make improvements in 18 or 19, or in this instance, 20? So if so, then that falls directly in line with what the entire topic of this call is. Yes, it's if you made improvements in that period, time to look at them, time to sit down with your CPA. You're probably already thinking of some big examples, big ticket items. So yeah, will it help you? We can't answer that, but should it? It should definitely create opportunities. One other thing to caveat to point out is, depending on perhaps your leases, going back to the CARES Act and the definition of qualified improvement property, CARES implemented that the improvements must be made by the taxpayer. Emphasis on made by the taxpayer. So if a tenant made improvements, and it might not be something that you can take advantage of, but other than that, just look to your improvements, and like I said, sit down with your CPA, crunch the numbers. You should be able to take advantage of this.
Yeah, and
Thank you, Lee.
Just to touch on that, not only the qualified improvement property, but I think if they own a number of commercial and or residential properties, going in and doing that cost segregation, if they haven't already done it, very well could generate that benefit to generate some cash that allows them to keep those good tenants, and not have to go and renegotiate all their bank debt and all of those types of things. Maybe still a good idea to do those things too, but the benefit from my perspective for that person who's struggling to make it through this time without having to dip into other resources, this is a great pot of resources that you can potentially dip into using these benefits.
Sure, it might also be a good time to evaluate the grouping elections with that as well. So.
Yep. Okay. Thank all four of you rather. Here's another question, and it's similar to one that was asked before. it appears that much of this is directed towards qualified real estate professionals. I am a doctor and own many of the properties that you all have been talking about throughout this webinar. All of them are income generating properties. I am not a real estate professional. I have a net operating loss of $500,000. What does this mean to me? One, will it benefit me? Two, and how do you see the risk to me? Will my CPA be okay with this?
Joni, you want to take that
Drew,
one?
I'll hand it to you. Jonah?
Yeah, so I'll comment. If the physician is generating a business loss from his core business, the 461L provisions, that's that excess business loss rule, those could be carried back. There are things that we could talk about if he's married, that maybe a spouse is a real estate professional, and maybe she's the one that's working in the real estate. So I think we need a bit more facts upon the situation to determine, how we use those real estate losses. But certainly, if he's running a loss from his core business, certainly that can be carried back and could free up some cash. There are some ways that we could structure the real estate holdings and structure the business that might provide some flexibility, but we could certainly talk about that more specifically.
Yeah, I want to mention this one thing. I got a question. I got a question offline about this very thing too, and it may be that certain real estate holdings, especially if you go back 2018, 2019, and you weren't a real estate professional, you may not be able to benefit in those years. However, if you could become a real estate professional, or your spouse, as Jonah mentioned, in 2020, and you're a real estate professional in 2020, and we take those deductions and excess depreciation and all of that stuff in 20, we could carry it back. Now, the negative to doing that is you're going to have to be a little patient, because you got to wait, file your 2020 return, and then carry it back. So there'll be a bit of a process, and a lot of people are wanting cash now. However, your owner-occupied real estate, so you own real estate in ABC LLC, and you rent it to XYZ Corporation, which is your medical doctor corporation, you should be able to group those two activities, and it doesn't matter that you're a real estate professional. That ABC LLC can take deductions, and you can use those even though you're not a real estate professional.
And Drew, that is a big point, and I'm glad you mentioned that. And I want to make sure that we come back to that. And I think maybe that's where the participant was going with that. But so to the last part of his questions, assuming it hits what you just spoke to, Drew, and they've got a $500,000 NOL, but over the previous 5 years they paid taxes of $2 million. What could this mean to them, and what could happen, and how high could they go? And then how do you see their overall risk profile changing for them from a tax filer perspective?
I mean, theoretically, they could get all $2 million back. And we're certainly seeing cases where some of our tax-paying clients will get every penny they paid back to 2013. So that's certainly possible. It's all facts and circumstances dependent. And I think facts and circumstances dependent relates to their audit risk too. I mean, I think if one of our things is, I don't mind taking an aggressive position, but it needs to be one we can absolutely win. So, you need to be prepared that you may have to defend yourself to show that you are a qualified real estate professional. So keeping logs and records and things like that are very important, and seeking counsel, because not everything you do relative to real estate means you're a real estate professional. There are carve-outs for what you do as an investor. So it's really important, and it's a pass-fail, and you need to be able to withstand some scrutiny. And one of our other kind of bedrock principles is, I don't want to win. I want to win by a couple of touchdowns. So in other words, if I need to get to a certain number of hours to be that real estate professional, I don't want to eke it out on the number. I want to blow past the number a little bit. So if they come back and throw some of those hours out, I don't fail.
Right. And I know,
the rules always provide a lot of risk.
Okay, not everybody.
Yeah, just to speak to the NOL.
Jonah, why don't you go ahead? This is a core COVID-19 issue everybody's dealing with in video conferences and webinars, speaking over each other. I know everybody wants to talk. Jonah, will you go ahead and address that, and then we'll go to Brandon?
No, that's okay.
And after that, Cammy's sitting on a bunch of questions that have come in, so let's hit these quickly and jump to the questions in queue.
Yeah, I was just going to mention that there's a lot of nuance with self-rental, but it does, in most cases, convert passive income into non-passive income or loss. So, but it's an area that a lot of people get tripped up on. So we're more than happy to look at that and talk through some of the planning related to a self-rental transaction.
Okay. Cammie, will you go ahead and jump into some of the questions that have been coming through chat and in queue, please?
Sure thing. Question, can my CPA perform a cost segregation study?
I'll take that one. The IRS allows 3 methods for accelerated depreciation. The first 2 methods a CPA can probably perform. One of the reasons CPAs bring in engineering firms is because those 2 methods allow less items you can carve out to a short tax life than an engineer's method. So the answer is yes, your CPA can do one, but they find less benefit. I find anywhere from 10 to 15 less benefit. As a general rule, sometimes 20% on a $5 million building, just 10%, is another $500,000 in deduction. In a 40% tax bracket, that's $200,000 in your pocket. And these studies are relatively inexpensive, even when an engineer performs one. So yes, they can, but there's probably more benefit through the detailed engineer study.
Okay, thank you, Jamie. Question, what is the cutoff date in 2020 for qualified improvements?
Yeah, so as far as in 2020 this year, there is not a cutoff date, so to speak. For this year's return, you'll need to claim those deductions on the 2020 return. Where it's important is for the prior years, so 18 and even 19. If your return has already been filed for 19, then you're going to have to amend that return potentially, and the same is true for 18. And so if you had qualified improvement, then you need to go ahead and look at filing a amended return. Generally, you have 3 years from the date, or the later of 3 years from the date the return was filed, or 2 years from the date any tax was paid. It's usually that 3-year rule that applies. So to answer your question, okay, it would be generally 3 years from the date the return was filed.
Yeah, and so, but I want to hit this point just quickly. It's not that you have a certain deadline to deal with qualified improvements per se. It's if those qualified improvements may arise in 18 or 19, especially 18, that's where you really have a potential issue, is dealing with that June 30th date of either electing to carry it back or electing out of it. It's not the fact that the qualified improvements are an issue themselves, an issue back in 2018. So while you want to really be focused on look at your returns and stuff back to 2018 and say, do I have any of these issues where I can be carved out of this?
Okay, thank you, gentlemen. Next question. As most states are not complying with these federal rules, does this create any hesitancy in your mind to claiming the carryback claim? The way the New York statute is drafted, it's possible a carryback will cause an individual taxpayer to lose the value of the NOL unless New York State modifies their statute.
Yeah, I could take that one real quick. That's a great question, one that we're looking at all the time. You know, some states also don't allow bonus depreciation as well. Not all states are federally conforming. So the short or the long is we don't know. We have to model it out. We have to see if the increase in NOL federally outweighs any additional tax at the state level because of that interplay. It's also important to understand what is generating those losses. Is it excess business deductions? Is it accelerated depreciation? Is it bonus depreciation? Is it other items that we're accelerating? So the calculus is not simple, but it is a very important part. One piece of the overall model that we would do for clients is to see what the benefits are and the timing that we should be mindful of when considering amending these returns to carry back to generate refunds.
Thank you, Jonah. Next question. What, if any, bonus depreciation provisions were included in the CARES Act?
Bonus depreciation was a part of the Tax Cuts and Job Act of 2017. So when you use the word bonus depreciation, that has one meaning. The other meaning, the qualified improvement property that is eligible for 15 years deduction is now eligible for the bonus depreciation from the Tax Act. So don't get too caught up in the wording of bonus depreciation. That is available now, but that's a change. That's why it's so important, as Brandon was talking about on these deadlines, as Jonah was just saying about these classifications, is it's easy to get tripped up on the language in here. That's why a thorough review should be possible.
Yeah, bonus depreciation, like you said, Jamie, that's existed. What majorly changed is this qualified improvement property became eligible for bonus depreciation.
Correct.
Okay. Thank you, Jamie and Drew. Let's see. We had a question come in, I believe, possibly Brandon, this might have been while you were talking. This assumes a long-term holding horizon with respect to the asset, correct? Otherwise, ordinary income depreciation recapture might be a nasty occurrence due to cost segregation.
Yeah, I mean, number one, you're right. If you do a cost segregation study and accelerate depreciation, then you're going to increase potential for recapture. I think the important thing to remember, though, is this is a moment where you can't let the tax tail wag the dog necessarily. You have to look at it holistically, look and evaluate, does the client need cash? And if we're really talking about needing that cash flow right now, then maybe it's better to go ahead and accelerate that. And if they are going to have a liquidity event, though, in the very near future, then yeah, maybe it's better to convert that or forego the bonus depreciation and waive the carryback at that point, and so that you'll capture the capital gain or more capital gain than you would convert it to ordinary income. But there are also strategies for deferring that income. So I think that you have to just take it. It's a holistic analysis. But you're right. Yes, it would increase that potential for total 45 recapture.
I want to point something out. And our clients, in many cases, they own dozens of properties, and so I agree. If you know you're going to sell that property in the next 5 minutes or year, you want to be careful about that. But I agree with Brandon. At the end of the day, it comes down to you've got to prioritize your goals, and prioritizing your goals very well may be I need cash now to sustain and to survive this crisis. The other thing I would say is in many cases you've owned property for 4, 5, 6, 7, 8, 10 years, and you're bonus depreciating improvements and elements to the property that truly are reducing in value. So when you go to sell that property, you may not be allocating to some of those classes of assets anyway. And so while the theoretical calculation is, well, you're going to pick up all that bonus depreciation as recapture at ordinary income tax, that may or may not necessarily work out that way.
Okay.
Tammy?
Thank you, Drew. Yes, I've got a question for the Dwyer team. I acquire, own, and manage office buildings. I look for underperforming properties, and often these require significant renovations. How do the changes under the CARES Act benefit me in connection with the substantial funds I use to make these renovations?
Well, that sounds like a very typical client, someone who wants to own properties, non-residential properties. Let's say it's office buildings, and very typically, we run across clients who look for good acquisitions in the sense that maybe these buildings are underperforming, they need some renovations, and a client will get in, buy the building, advance fairly significant funds to renovate the property because he wants to improve his tenant mix and obviously increase the rent. The problem is if you're in that situation now where you've done that and you've been caught up for the last 2 or 3 months now in the stay-at-home orders that we're seeing from the different states, we're finding that tenants have stopped paying rent and are requesting deferrals, and the property owner is not always getting the benefit of that kind of forbearance or deferral from its lenders, particularly if it's a collateralized mortgage-backed security. Those are very difficult lenders to deal with. So I'm finding clients that are in almost dire need of cash. And what this CARES Act has done is provide a means to get to the cash, even though the rent is not flowing. Because now, having made those substantial improvements in 18 and 19, that client can fully depreciate those improvements in the year that they were incurred and placed in service, and can carry them back 5 years. And as you've heard on this excellent webinar today, carry them back and generate cash in fairly short order. So that's what the CARES Act does. It particularly for real estate investors that are short on cash today because of the rent situation and this COVID-19 period. That type of individual has a substantial chance to generate cash today to tide him over until we get through this crisis. And that's a very good question. We're seeing a lot of people in that same boat.
Thank you, Steve. And a follow-up for you, which industries will benefit the most?
Which industries will benefit the most? Well, I mean, obviously we know by the definition of the qualified improvement property, it's not residential, so it can't be with residential real estate, apartment real estate. But clearly, we're seeing situations where the CARES Act can provide this needed cash for individual owners in office buildings, retail scenarios, whether it's strip shopping centers. We're seeing that. We're even seeing it in malls. Anything involving the hospitality industry, especially, and I think that's going to continue. The problems with hospitality industry is going to continue probably longer than in any other sector. So businesses in the hospitality industry, restaurants, event venues, that type of thing.
And Cammie, this is Lee. I'll probably kick this back to one of the other panelists, but I guess an important overall point takeaway for our listeners is this doesn't necessarily have to arise out of a real estate loss. It could just happen to take advantage of these carryback provisions just from in any business. How about that? And I think that was pointed out at the outside of the call, but this isn't just for real estate business owners.
That's very true. Just the reason we focus so much on real estate is it's one of the biggest hotbeds of opportunity to go and fabricate. That's a bad word, but I'm going to use it anyway. Almost fabricate these losses by using depreciation and other tactics. But you're exactly right. An operating business that has a loss, this is absolutely for you. And especially if you're operating business and you've got a loss, especially in 2019, you can go ahead and file your tax return and carry that back to 2014. So it absolutely is applicable to many businesses who may not be thinking it's applicable to them.
Okay, I have another question. I built an additional location for my dental practice in 2019. We expect a large NOL for 2019 based on accelerated depreciation allowed in the Tax Cuts and Jobs Act. We expected to take these losses gradually over the next few years. Am I correct in thinking I am eligible to carry these losses back and generate refunds against prior tax payments?
Yes, you are correct. And with the caveat of you need to talk with your tax advisor or one of the people on this call to make sure that that real estate is treated properly for you to be able to utilize that loss. If it's not, then that loss will be considered non-passive. You would only be able to, would be considered passive, excuse me. And you would only be able to use that loss against passive income, which your business would not be passive income. So if you group it correctly using the proper grouping elections, you should be able to turn that loss that would otherwise be passive into non-passive and use it against your active business income, carry it back to 2014 and take advantage of it from 2014 forward. Thus generate.
Drew, this is Chad. Drew, this is Chad. Let me kind of take one question we got and bounce it off of that one. So thinking about another individual who sent something that's similar. So they're not a qualified real estate professional, right? But they do have owner-occupied facilities that they use in their business, in addition to other things that they invest in from a passive perspective, like rental properties and vacation rentals and residential real estate. Are they going to be limited just to the ones that they use from a owner-occupied perspective in their core business as not being a real estate professional?
Yes, if they are not a real estate professional and we can't get them into the posture of being a real estate professional, which I would die trying to do that, but we would need to make sure we got, everybody got comfortable with that. Let's assume we can't, they cannot be considered a qualified real estate professional, then yes, they would only be able to take and that yes still has some caveats with it, but yes, they'd be able to take the benefits on their owner occupied self-rental real estate, provided that they make the proper elections.
And going back to the previous question, for the dentist who asked the question, is there a way to be a dentist in your day job and also be a qualified real estate professional?
It's a tough road to hoe, and the reason is because you've got to be working that profession 750 hours and more than any other job that you serve in. That's the problem. The "and" is the real problem there. That's why most people try and get their spouses to qualify.
I thought so. Thank you very much, Cammie.
Okay, another question. What is the time frame for receiving tax refunds?
Brandon, you want to
That's an
address
excellent question.
Yeah,
Brandon, why don't you tackle that one?
Sure. So for 18 losses, if you have an NOL and you're going to do a tentative adjustment request, then that has to be filed by June 30th. That's your deadline. For 19, you're going to have until 1 year after that. We're just now filing the return. Now, if you filed your return already, that deadline will run from the date you filed the return. If you forgo the tentative refund request, you can always file an amended return, a full-blown amended return. And the timeline for that is 3 years from the date the return for that year was filed. So for instance, 2 years 2018, you would have 3 years from 2018. If you file it in October, let's say, then you'd have 3 years from that date, assuming it was properly extended, to file an amended return and get a refund for that return. But it's that tentative adjustment request that generates that quick refund that has to be acted on by June 30th. And it's critical that you do that if you're looking to get utilize an NOL from 2018.
Okay, good job.
Okay.
Kimmy, I have one other question that came in through the original line, and it's a good question. It says, I currently have a CPA and we have not discussed these matters. Do I need to reach out to my CPA or do I need to call you guys to make sure this can happen for me? I am not sure if my CPA knows about this. Good question.
Yeah, it is. And I think that, look, we put out a piece not long ago, because sometimes I think people look at us and think that we're somehow competitive with their CPA or their lawyer or whatever. And the reality is we're not. We seek to add the most value to our clients. And if they can get that value from their CPA and they're super sophisticated and they're all over it and they can do a great job for you, fantastic, go work with them. If for some reason you think maybe your CPA is too busy, they may know about it, but they may not be an expert in it, and it may be better to bring in people who this is like what they're focused on. I mean, this isn't just ADDICUS doing this. We brought in professionals that this is like all they do is focus on these types of issues, such as Jamie Pope. And so if we could be helpful, we would love to be helpful. But if your CPA could do a fantastic job, great, go work with them, no problem.
So if that's the case, should we reach out to you guys first, or should we reach out to our CPAs? What do you recommend? Especially with time being so sensitive.
You know, I think my concern at this juncture is we do have a team assembled to focus specifically on this. The CPAs, if you think about it, are still in the midst of all the PPP loan stuff. They're in the midst of tax filing season. They're reeling from everything that's going on. And most of the CPAs I've talked to are a bit overwhelmed at this point. But if you want to start with making a phone call to your CPA and kind of gauge their level of interest in being able to get on this, I mean, the question I would ask is, how confident are you understand all of what goes into this, and how quickly can you get on this issue? Those would be my two barometers of how comfortable do you feel with letting your CPA handle it. It's not that they can't handle it.
Right.
I think they're a little overwhelmed.
Right. And the last part of that, Drew, is because I don't operate in this industry, I look to my CPA to give me counsel as to certain tax positions we take. Would you all be willing to work with my CPA?
Certainly. We do as a matter of practice, day in, day out.
Okay. Thank you very much. Kimmy, are there any more questions?
No, sir. That's it for now.
Okay. Well, thank you, everyone. And we appreciate you joining and sticking with us and staying tuned to the things that we're putting out. And to all our panelists and partners, we appreciate your participation and everything you do to serve our clients every single day. We look forward to working with you to continue in this space. As it relates to the materials and a recording of the webinar, we will put that on our microsite through ADDICUS, and it'll be available to everyone going forward. In the event that you have any questions, we are here to help. Our contact information is included. We would love the opportunity to talk to you, work with you, and certainly be happy to talk to your CPAs or anybody. So thank you very much, and stay tuned.